Let's have a look at identifying relevant cash flows and summarizing what we need in order to be able to do a project evaluation before moving on. If you're trying to work out which cash flows to include in an investment evaluation, you've got to ask, the first question is obvious. Is it cash? I think we've made that point quite clear throughout, that cash items are the relevant ones because they are ultimately the ones that we need to finance. The second question we have to ask in determining whether to include a cash flow or an item in an analysis is, will the item change based on whether the project is undertaken or not? Right? If you've got an item that is not going to change based on this decision, then it's not relevant for the decision. You only need to think about how is this decision going to be different from not taking or from taking the alternative. Okay, so for an item to be relevant, it has to change as a result of the decision. If it's the same across all versions of the decision, then it's not relevant for making that decision. Okay, so a few examples. YK company owns a factory and it rents one half of the factory space to somebody else for $3 million a year. YK plans to expand its operations. This plan calls for the cancellation of that rental arrangement with this other guy and for YK to occupy that previously rented area of the factory. YK estimates that the net cash inflow per year from the expansion operation is $5 million a year. What's the incremental cash flow? What's the incremental net cash inflow for YK? Well, it's clearly going to be $2 million. We're asking ourselves the question, what changes if we make this decision? If we expand, we are going to use this space which is currently rented. So that rent that's coming in is relevant. It changes based on the decision. So by taking this decision and doing this expansion, we are going to have inflow from the actual project of $5 million a year, but we will be giving up from our existing situation an inflow of $3 million. So we're making, as a result of this project, only an extra $2 million a year. $5 million over and above the existing $3 million is a $2 million increment. So the answer is D. Okay, let's say that a firm is to market a new product which will compete with one of its existing products, thus reducing sales of the product. Interesting. This is cannibalization strategy. I don't know if you've been reading about the whole Kmart Target cannibalizing each other situation. So the new product sales are $3.5 million a year. The lost sales of the old product are $0.4 million. So if we take on this new project, yes, we will have new product sales of $3.5 million a year, but we're going to lose sales on some of the old project of $0.4 million. So what's the incremental cash flow from sales from taking on this project? Clearly, it's C. It's $3.1 million. We're getting $3.5 million additional in sales from taking on the project, but as a result of taking on that project, we're losing 0.4. So both of these numbers are numbers that change if we make this decision. If we make this decision to market the new product, we get an extra $3.5 million a year from the new product, but we lose 0.4 million from decreased sales on the old product. Okay, so they're two examples of incremental cash flows. Now, I did make a comment earlier about the difference between accounting and cash flows, and this is important to understand. Large companies, as part of their accounting process, will often allocate expenses to different divisions. So you're spending some expenses on central admin, and because you're employing some accountants or something there, you take on and you open up a new division and you say, right, you guys have got to include in your income statement your share of these costs that are being borne. And for some accounting decisions, that does make sense. But for investment decisions, it doesn't. The question you always have to ask is, if we open this new division, are we incurring additional costs? Because if we're just reallocating costs that are already incurred, then that cost is not incremental. The fact that you've rearranged how you report it does not change the fact that you're spending that amount whether you open the new division or not. So this accounting allocation of costs to a division is not going to be relevant for making the decision. You should only be looking at actual changes in cash flow that change if the decision is taken. So in project evaluation, what we are expecting to do is identify the costs, so the upfront cash expenditure, identify the cash inflows and cash outflows, so get net cash flow for each period. And as I've already flagged, and as we will look at soon, we need to talk about tax. Because for tax, we're going to calculate a profit, not because that profit is a cash flow, because that profit is a bit of information that is sent to the tax office. We calculate taxable profit according to tax rules to fill out a tax return. We need to calculate that because that tax return impacts how much tax we pay. And that tax we pay is a cash flow that we're concerned about. And of course, the other thing we need to think about, projects have a finite life. And at the end of those projects, there might be some terminal values. For example, you invest in some assets. At the end of the life of the project, you can sell off that asset, perhaps for less than you bought it for, but it will have some terminal value. And that might be different than what it's recorded for accounting purposes. Now, so if that's not too far away, and you see that there's this salvage value, that's a cash flow that's involved at the time you exit the project. You should also think about that working capital. Up front, you invest money in all this inventory. There's money tied up in inventory and accounts receivable. At the end, when you shut down that project, they sell off that inventory, they collect that accounts receivable, and they don't replace it with new inventory and accounts receivable. So that's also a return of investment when you run down your net working capital at the closure of a project. Okay, we'll talk about taxes next.